not the best. Like, it's not the best outlook that the world's been in before. You compound all of this with Ukraine and Russia and Israel and Hamas. And I don't know if anyone saw this, but 2 Navy SEALs just died in the Gulf of Aden yesterday, right off the coast of Yemen. And so there's just a lot of crazy stuff happening. Our energy infrastructure globally is very fragile. And so I think that push is coming to shove with debt payments. The biggest issue a lot of people in Congress had with raising the Fed raising rates was that our debt payments are now approaching $1 trillion a year, which is very well documented in almost all of our quarterly updates that you guys are welcome to read. But I know for this, we're supposed to be looking at DCF. So just kind of giving you guys a backdrop on this. And if you do want to look through this article and download some of the other models, some context on those for your understanding. Yeah, so this kind of furthers that analysis, looking at the total household wealth, the growth from 2019 to 2021, pretty meaningful. And a lot of that was because of the stimulus packages, objectively, and that's pretty well documented as well.
Eli, sorry to interrupt, just a quick question. Are you going to be talking about integrating these more macroeconomic factors into DCFs and stock analysis?
Absolutely. Yeah, no, I'm glad you brought that up, PJ, because that is where they connect. And you guys will see as we complete and update this DCF how often you have to make your own assumptions and be able to justify them, because underwriting any sort of investment is definitely both an art and a science, where as a critical thinker, you need to make assumptions that you can back up with, macro data or historicals or comparables, and use that as your baseline for your analysis. Yeah, great question, Mr. PJ. But yeah, sorry, this is a super long and boring article. Once again, I find it interesting. This is stuff that I've been looking at for a really long time. Here's another super simple Excel model that we compared, some of our favorite assets like Berkshire Hathaway, Apple, Bank of America, Tesla, Twitter, Bitcoin, Ethereum, when Twitter was public. Would be curious to hear people's thoughts on if it's better off in Elon's hands. I think it probably is, but we'll see. But you can just see how at this time, even Berkshire Hathaway was down about 15% from all-time highs. So this was like kind of early on in the market pullback, and a lot of these have come down even harder since. Others have bounced back. I mean, we've seen the S&P hit new all-time highs even in the last 24 hours, which is unbelievable given kind of the macro backdrop that I just described. But all right, now for the fun stuff. It's pretty ironic. When we did this analysis, we did Tesla and Twitter. We're huge fans of Elon, if you guys can't tell, for a lot of reasons. But basically, in our analyses, we saw that Tesla was primed for a J curve like growth, and once they reached profitability, basically that they were just gonna flywheel. And we'll kind of update those numbers now and see if our analysis stood the test of time. But interestingly enough, our Twitter model showed the exact opposite, basically that the company was in existential crisis and going to go under, which is exactly what was revealed after Elon's takeover, firing 80 to 90% of the staff, tweeting that the entire company is bloatware and that it's like been completely improperly managed, and essentially just that it was like a government entity within the private sector employing a bunch of certain political leaning people to push a message, which is pretty interesting. I don't know all the facts by any means, but it was cool to see, like, in our numbers, the story that we were finding become true when Elon actually purchased the company. So yeah, for anyone following along, feel free to download these models. You will need a working version of Excel, which you can get through Wharton, but that is something that we cannot provide you with for now, but we can help you outside of this call get Excel if you need help with that. Okay, so a lot of this DCF model is more automated than most, which you'll find. And then also I talked about those assumptions. So for example, this highlighted 76% has a divided by 2 after it. And that was because, we were noticing, kind of to PJ's point, that their provision from income tax grew aggressively, really, really aggressively. And on a go forward basis, modeling that was questionable because we weren't sure exactly the regulatory environment that we were heading into with taxes. We were not sure about actual growth profits, which we'll get into as well. But that's kind of, as PJ was talking about in his question, an important thing to consider as you do any analysis is what sort of environment we're in at the macro level, because that will impact a lot of your assumptions, particularly when it comes to growth rate. So as I mentioned, this model is pretty automated. So even like opening it up, it already pulls in the current share price of Tesla today. When you guys, in the future want to do this with other assets, you just type in their company ticker here. Anything in blue is basically an input that we have to adjust, and then anything in black is a formula. And that's just pretty standard Excel. How do I call it? Protocol, I guess, or formatting is where blue are your assumptions and black text is your input. Or sorry, your formulas. But yeah, so as you guys saw, basically when I switch this from Tesla to Apple, everything up here automatically updates, which is pretty cool. The most important thing is the share price. And then the second most important thing is our predicted share price. So if you scroll down here, we actually have an option in this model, which is a pretty nice feature, if I do say so myself, where you can pick what year you want to model to. So if we have, I think, up to 2030. Oh, we actually have up to 2035. So yeah, once again, you're not really gonna take that much like weight behind a 2035 number just because it's so far in the future. Like so many things could happen that it's like a little bit ridiculous to project out, more than like 7-8 years. But what's cool about this one is you can pick what year you would like to see the cash flows go until, and it will update your model accordingly. If we have time, I'll talk through some of those formulas, or you guys can just play around with the model yourself and back into the formulas that allow a lot of this automation. But it's really cool because most of the time in DCF models, you're doing all of the inputs by hand and then all of the formulas by hand.
Oh my.
Um, I don't know if he was that excited about the models. I don't think so. Um, yeah. But any questions so far? Any concerns or things anyone wants to point out as we get ready to dive into this?
Yeah, I had a quick question, Elijah. Could you just walk me through? I'm a little bit of a beginner when it comes to financial modeling. What even is a DCF and I'm just kind of confused what we're looking at here.
For sure, Shane. What a good question. And it definitely can be confusing to look at for the first time. Um, so it's especially confusing right now because my model is auto updating from when we first did this 2 years ago. And so what we're gonna see is that this 2019 revenue number, we're actually gonna need to shift our start year to 2019 so that the projections are basically for this year forward. So just as a preface, it is like in a confusing state because it was from 2 years ago and now we're going to update it. But in general, a DCF is basically an analysis of a company's 10K. And a 10K is an annual report that all public companies are required to do. So if you go to Tesla's website, which is a great transition into actually updating the DCF or completing a DCF, um, wow, I don't have good SEO. Kyle, I need to talk to you about getting some better SEO. Had like 4 or 5 websites in front of them. But so as you can see, like this is Tesla's website where you go to buy the cars, where you learn about the charging and solar panels that they have, which is really cool. Honestly, what a great company. Shop, you can even get a hat. But they also have to have their investor relations on here. So let's see. Usually you kind of do have to search for the investor relations, especially if it's a consumer product company. But every company is required to release a 10K. So yeah, Tesla has it. I was gonna do tesla.com/IR, but it's ir.tesla.com. And every public company has this. There's another way to find it through the SEC's website, which is called Edgar. And here is where, yeah, you can go to any company's filings and they actually order them. So right as these companies do their reporting, and these are massive documents, we're talking hundreds of pages of financial statements, risk disclosures, other updates to the business. So these are very hefty. I actually helped work on a couple of these at my former employer, and it was up there with fun documents as the biggest headache. But yeah, Edgar's cool because you can like get it directly from the source, but their website is the exact same thing. So if you guys ever find a discrepancy on Edgar's 10K of the company and the company's website of the 10K, you could probably win a massive award for detecting fraud from the SEC. Kyle and I have actually called out several fraudsters, and a few of them have actually gone to jail. We're still waiting on our fee from the SEC, if anyone knows anyone there. But so 10Q is a quarterly report, 10K is an annual report, and an 8K is another annual report that includes earnings and I believe ownership changes. Like you have to file an 8K if you change ownership in your company, which most of the time does happen throughout the year. But definitely correct me if I'm wrong on that, because I'm not actually, I haven't worked with 8Ks a lot, but 10Ks are pretty much the standard because it's has everything. It's an annual report. Like 10Q, you're really only getting quarterly data. 8Ks, you're only getting very specific parts of the 10K. But the 10K has it all. And so when you're here, we're looking for not 10Qs, but a 10K. So it looks like they haven't done their 10K for Q4. There's usually a little buffer the SEC gives you. I want to say it's until March, maybe. We could look that up really quick. Yeah, March. So companies basically have to file their 10Ks by March, or the SEC will basically shut you down and not allow anyone to trade your stock anymore. So pretty big deal getting these done. Even bigger deal understanding them, which is really what is the hard part of doing a DCF and doing finance in general. And a big reason why it is gate capped is because you need some pretty serious discipline and focus and ability to sift through these massive, massive documents. I'm on like some Chrome PDF reader, so I can't even see how many pages. But if we just go to the bottom quickly, you'll see, yeah, 107 pages of risk disclosures and financial statements. So pretty hefty. And most companies are really good at hiding their dirty business in these documents. In fact, when I first started underwriting Tesla in like 2015, I was like, wow, this company is so great. Like their gross profit is so high. And then I remember like talking to some of my mentors and peers about it, and they're like, yeah, the gross profit doesn't include any of their costs of their cars. And so their net profit was basically like extremely negative. And that's one of the most common things you'll see looking through these is that they try to trick the lay investor, honestly. And it's crazy that, the SEC allows this, but it is what it is. And they require all this disclosure because they put the onus on you as a retail investor buying stocks through your brokerage account to do the proper diligence to make a good investment. So they're a regulatory body that basically tries to help protect you as a consumer. But still there's some flaws in, of course, the organization and the processes, and people even like during kind of the whole Uber cycle, were creating their own metrics. Like Uber had their own profit metric that like no one else used, and then they got under investigation from the SEC about it and had to change it, and their numbers like tanked. So it's funny. Even like I think the Warby Parker guys from Penn and Wharton had like some pretty shady reporting. So it's really important to like take good care in understanding what's going on in these before you invest in a company. So once you start seeing these blue and white lines, that means you're looking at official financial statements, which is pretty cool, pretty exciting. Oh, also here's a huge hack. We're actually going to start off with this. I was just showing you the 10K for like proper protocol, but you check it out. This company, Kyle, my partner, who I think you guys all know, he taught a masterclass last semester. One of the smartest people I've ever met, hands down. But he showed me this website called ROIC .ai. In the real estate world, ROIC stands for return on invested capital. I don't know if that's what it means here, but that's what it resonates with me. And this actually allows you to look at the financials for any company in a way nicer way than the 10K. So what this company does is they scrape 10K data from Edgar, and they upload it into a much more user-friendly experience. Something that there's a lot of arbitrage to do. Actually, even if anyone here wants to, take the 10K and turn this into some software, talk to us, because we could probably make a very profitable company out of that. We've talked about this for a long time. And in general, you're seeing a massive shift from the innovative but now outdated financial infrastructure such as Excel into more software-based systems like Roic.ai. Pretty cool, pretty great. Basically a cheat code for reading the 10K. And when Kyle showed me this, I was stoked, but I was also bummed because I've had this idea for so long and don't have the development skills to do it or anywhere near. Shane and I talk about this a lot, but everyone has ideas and ideas are amazing, but being able to implement your idea is how you win. And that is the harder part for sure. So that's what Black Mountain's here to do, though, is help people bring their ideas to life and have their companies grow and succeed. So if anyone wants to work on this or anything like this or has an idea in general, we are here as a resource to help you guys turn your dreams into reality. Like Roic AI did with my dream of DCF software. But yeah, so the reason I pulled up the 10K though is because it looks like these guys do not have 2023 data, which their 10K doesn't either. So we can just use Roic.ai. But it's important to cross-check the 10K and kind of be able to look through these. So I'm just going to spend a little more time on the 10K. And then we'll dive right into Roic.ai and the DCF, which, yeah, once again, in a DCF, you're basically looking at simply all of their financials and discounting those flows based on a rate where, and we'll go into this in a lot more detail as we get through the model, but you're basically copying in their financials, their revenue, their expenses, their taxes, their depreciation and amortization, all of that stuff, and then you are discounting it back. And is anyone here not familiar with the term discounting? Because this can be a little confusing.
Yeah, I'm a little confused what the actual goal is of it.
Yeah, definitely. So the goal is to get an implied share price. So that was the main output. That's what I said was the second most important number at a certain year. So you can change the year if you want to see what your model's showing will be the share price in 2030. You can. Usually, like I was saying, 5 to 10 years is probably good. Anything more than that, you might get laughed at just because it's so unpredictable. But yeah, the end goal is to get a implied share price based on every aspect of their financials that's important to its sustainability. Does that make sense?
Yeah, it does. Thank you.
Absolutely. Thanks for the question. But to get there, a big part of it is conceptually understanding what a discount rate is. And this is probably the most important core concept in all of finance. And it's something that is really hard to understand at first. And then when you get it, it just clicks and makes perfect sense. I feel like Evan, you might be able to explain this really well or not, but no, okay, fair. But yeah, it's also a pretty important consideration in real estate and construction, because your discount rate can almost be considered a combination of opportunity costs, where else you could have put your capital, combined with inflation. So what I mean by that is that, say that and most people use this as their discount rate. They use the S&P 500's annual returns, which call it 10%. That's the most standard discount rate in existence, is 10% S&P average returns. And what that means is that if you put your money in the S&P, it would grow at 10% every year, right? So in 2 years, your money would be worth 10% compounded. So that's not only just 20%, that's 10% on the last 10%. And as you guys, we can actually just model this really quick to show you kind of the power of compounding. So let's do that 10% growth rate on $100. If you were to do that 10% growth every year. Also, to lock a cell in Excel, it is F4 on the keyboard. so that when I copy this over, it actually stays with that 10% versus if I chose to not do that, if I chose to not lock the cell, you can also just type in the dollar signs, but it would give a 0 because it's pulling from this next cell versus with this formula, I locked this 10% cell so that as we copy it over, even though this part's moving, like the multiple is moving, the 10% increase stays the same. So as you guys can see, in the first year it grows 10%, and then on the next year it grows 10% on that 10%. So it actually ends up being closer to 21%. Right. So 21%, pretty good. And then you can see that happen. Oh, I might have not locked the cell. Yep, didn't lock the cell. So I'm gonna lock 100 because this explains really what a discount rate is. Because the idea is that if you were to invest your capital somewhere, call it the S&P at a 10% discount rate, then you would assume that your money is going to be worth more in the future, right? Just like if you were to hold cash, your money is going to be worth as much next year as the inflation rate is. And that's why banks usually offer slightly more than interest rate on their savings accounts. So we're really in an interesting time because I'm sure people are seeing like ads for oh, LT said, can someone share the link to the Twitter DCF? Yeah, so once again, LT is just on our website in this macroeconomic approach to analyzing volatile markets. Should probably make that just more clear in general that it's just like a free DCF on our website, but we do kind of want to encourage the learning. But yeah, we can definitely do that. Anyway, the discount rate is this making sense? Like what I'm talking about with like kind of growing your capital and the opportunity cost, like if you're putting your money somewhere, it's going to be worth a different amount later on, sometimes less, but more often than not more because of inflation and because the US in particular has such a successful track record of successful investments. Yes, no, maybe so. Thumbs up. Yeah, Evan.
So your example was talking about like the 10% compounded interest rate each year. How would that get affected by like inflation? Because that could be like
Yeah.
nominal,
Mhm.
right?
Great question. Yeah. So look, let's look at that. So if you're holding that $100 in cash at a call it 2% interest rate, right? No, Evan, this is a really, I'm so glad you brought this up. This is a wonderful and really important point where yeah. So I'll show you. This is exactly what I'm wanting to highlight here. Oh. Sorry, just having to do some Excel modeling magic because this is a really important illustration that Evan brings up. So yeah, exactly, guys. Everyone is losing money to inflation if you're not doing something with it. Like you're actually losing that 2%. And that's something that Evan just brought up with a real versus nominal value. A super important concept to understand because as money supplies grow, the amount of money that it costs for something usually increases naturally, right? Like if you have $100 in the system and then the government prints, 20 more dollars and it's now $120 in the system, the thing that cost $1 yesterday is going to cost $1.20 today in nominal value. Real value is inflation adjusted, which is what I'm about to show you guys. And that's when the discount rate becomes really important because if you're not investing in something, you're losing 2% or gaining 2% if you're in a savings account or a bank, CD, whatever that has that 2% growth rate, which like I said, most banks try to match current interest rates, like current bond rates, basically. So a little lower. And that's why you're seeing like real problems in real estate right now, where like you're seeing people, starting to take huge discounts on their properties because they need liquidity, and there's so little liquidity in markets right now, in private markets. And like I was just talking to someone earlier today, a really talented, successful, smart guy, saying that Blackstone's business right now, their secondary business is booming, not because it's like a good business model, but because all their other funds are selling to their secondaries business because they don't want to transact with third parties because it's gonna like crush their valuations. It's like there's some really gnarly stuff happening in private markets right now, all related to this, which is really interesting. But apologies for the distraction. Back to this example. Say this 10% line is basically the S&P earning 10% a year. Sorry, this line right here. I should make that maybe a little more clear. And then this line is the 2% growth, right? Where you have your checking account, whatever. To Evan's point, if you have your money in a checking account and not the S&P, your opportunity cost is technically this line every year, which, as you can see on a compounded basis, gets pretty high. This $38 actually ends up being almost 40% of your initial investment that you're missing out on by not investing in better opportunities. So like basically being lazy and keeping your money in a savings account instead of the S&P, which, you know, everyone has their own risk appetite and whatever. But right now, when you're seeing the government itself, like you know, essentially risk-free entity, offer like 4 or 5% on 10-year bonds, it's remarkable. And that's why real estate is having such problems because, you know, a year ago, investors were happy, or 2 years ago, investors were happy with a 5% yielding real estate project. And now you have that exact same return in a risk-free entity with no headache of doing the actual project, filling the space with tenants, dealing with the new roof or any other BS that you might come across in a real estate project, which is a lot. Or a private equity project or a fund or anything. So we're just seeing a shift basically because interest rates or because inflation got so high. This was actually at like 12%. That's kind of why markets started crashing, because people were finding it unattractive to invest in things like the S&P and went heavily into more risky assets. But then the Fed raised rates a ton, and now inflation's kind of back normalized. It's still higher than it should be technically because of all the stimulus we discussed, but now it's at least more normalized to the point where everything is going through a repricing. All the investment opportunities that were underwritten when rates were at call it 0 to 2% have now moved up. Like they need 2% more, at least 2% more margin in their business in order to stay at the same place they were 2 years ago if they were on floating rate debt. But back to the model and back to why we're even talking about any of this is because the discount rate becomes very important for an analysis like this. You guys can kind of see how this is like, you know, numerical, like chronological, where this is call it, you know, year one. And then this is year two. And this is year three and so on. Basically, I wonder if there's a way to formulate that better, but I'm sure there is, but we'll figure that out later. So yeah, you guys get the point though, basically where your money is going to be worth more in a future year than it is now if you invested in the right thing. And so the discount rate is designed to basically do an anti-growth number. So we're saying, like, if you guys look at down here, we're saying, look, in 2027, the free cash flow on Tesla, based on our outdated numbers, so this is going to change, is 233. I think we're in millions here. Let's see. We have some pretty good, yeah, in millions. So that's something you'll have to input too, is like what these dollars are in. You know, some companies are smaller, will be in thousands or straight up dollars. But this is a huge free cash flow number, like $233 billion in free cash flow at a huge terminal multiple, which is something we'll might have to go into now on another masterclass because that's also a little bit complicated. But we'll do our best to get to it. But anyway, then you get like a quote unquote terminal value. This is similar to a cap rate in real estate where you're basically like trying to think about how long are these cash flows sustainable given their debt, given the risk-free rate, which we have at 3% right here. We're definitely going to have to up that to 4%. And you guys, you know, beta is also involved, which is a risk rate essentially of the industry as a whole, not just the company. And then we have this average market return, which is the discount rate really that I was talking about at 10% would probably be better. And you'll see how this has a massive impact on our numbers. Check it out. It goes from $4.5 trillion as its 2027 terminal value to 3 billion if we just change that discount rate to a more accurate 10%. So it's a really important number. And then the risk-free rate's also involved. That's basically the interest rate or government bond on whatever timeline we're looking. So we would use a 5-year government bond to get this risk-free rate. And to do that, you just do a simple Google. I'm actually really curious. 5-year bond rate. Yep, so 4%. Nice. Still high, but that's an important number for us. And then actually increase our terminal multiple because we are using what's called the weighted average cost of capital, which is another number very similar to these discount rates, opportunity costs. And it's basically assuming like, how much does it cost your business to run every year? Like how much carrying cost does your business have? So our assumed WACC in these numbers is 10%. And that changes based on the risk-free rate, just slightly, but it does make a pretty big impact. So the whole point of the discounted cash flow is discounting what your future cash flows say, which is literally just a growth rate assumption. It's actually a pretty easy number to get. This is just like an average of the historical growth, and then you use that on a go forward basis to project what their cash flows are going to look like in the future. But then, of course, those are in nominal numbers. As Evan pointed out, there's a big difference between a real and nominal, and that's showing like, oh, well, those are just dollars. Those are tomorrow's dollars, assuming that we could be in the S&P or in Apple or in any other asset. We need to actually discount the future cash flows back at the rate of return that we think we could get elsewhere so we can understand those future numbers in today's dollars. And that is, once again, like a concept that is super confusing at first, but once it clicks, you just kind of start to think about the world that way, where, you know, between now and a finite point in the future, there's a million different outcomes that your life could be on or that your investments could be on. It could be, 100x, 50x, 20x, 2x, negative half, And so the discount rate is considering the average based on a historical S&P growth of 7.5 to 12.5%, and then bringing your future number back to today's number, today's like value of the dollar in our current inflationary state and everything based on that rate. And so please ask questions right now if this is confusing, because this is a pretty important part of the session. And just an important thing for all of you guys as young entrepreneurs, investors, business people to understand. And yeah, that actually took me a really long time to understand, but once it clicked, I was like, oh my gosh, it's so important to understand that. And you see, check this out. We move this 10% to 15. Watch what happens to our year 5 number of cash. Look how dramatically it changes. That's an insane difference. Just based on a 5% change in the discount rate or the growth rate. A discount rate is basically like the opposite of a growth rate, because it's like bringing it back based on what the growth would have been, essentially. Cool. So unless there's any questions, concerns, we will get into the actual completion or updating of the DCF, which I'm going to go kind of fast through just because this is something that will be easier to do if you guys do it for a new company. But for Tesla, we did this analysis in oh, actually, this could be interesting. So watch this with these H&P. This means historical and projected. So if we change this to when we did it, which I think was like May around 2022, you'll see that this projected is including 2022. Whereas now, if we leave this formula as today, it will show that 2022 and 2023 are historical, which they now are considering we've ended 2023, which means that all of these blue numbers that we typed in for 2019, we're going to have to shift 2 spots to the left. Maybe actually just 1, because we don't have the 2023 number for Tesla, which is a bummer for our analysis, but probably better for time, because it would be even harder. But that's something that you guys could do for fun, for practice. PJ actually, I taught him about this a while ago. He picked up super fast and started busting these out all the time and doing some really interesting analyses. And just like PJ did, you guys can use this, as a tool in your toolkit to underwrite different things and even like update it with new information that gets released from the company. So pretty cool. I think I'm definitely biased, but so what we're gonna do here is shift this to 2018 and really just fill in one extra number now because we have the 2022 data. We don't have the 2023 data yet. So we're gonna actually just override this and call it projected. Another way to do that would be to do this as the end of 2023 instead. But rather than messing with that automated formula, which for the interested in Excel people is literally just equals today with nothing in it. Pretty cool. Gives you the date automatically, and that's where all of this stuff is driven off as well. So as you guys saw when I changed the date from 2017 to 2018, there was also a very large drop in the implied share price, which makes sense if you think about it because it's saying like, oh, all this growth that we put in for 2019, that's actually 2020 data according to the model, which means that it's pushing everything back. But what's cool about what we're about to do is that it will actually allow us to get a more accurate analysis of Tesla. So basically we need to get a new revenue number for 2022 and we can cross-check our old one for 2021. And the easiest way to do this is definitely using the ROIC.ai tool rather than doing it in the 10K. But for reference, just so everyone knows, in the 10K, you could go back up to this revenue spot and see total revenues right down here. In 2021, we have that 53823 number. It's right on with ours, which is great. Means they have good accountants. And then next year in 2022, it went up to 81462. So 81462. This is definitely the most manual entry part of this, and it's important like to realize these inefficiencies because that's where opportunities like ROIC.ai are created because they notice that look, everyone is sifting through freaking PDFs in 2021 about all this data, and they just built a Python scraper and pull all this data into nice charts. And now they have a SaaS business where if you want the new data, you have to subscribe to it, and then you can like download it and copy it and manipulate it, analyze it, put it in your DCF. But for now, we have to manually type it. So anyone who is into like software dev and fintech, this is like such a ripe space for disruption. I'm so fascinated and compelled by it. But it is and we're still early. It's been developed, like people are definitely grinding and building some cool projects, but there's still a lot of opportunity.
I have a quick question, Elijah.
Mhm.
What is the difference between using ROIC AI and using the Black Mountain Investment Group financial model?
So we're actually getting new data. So when we did this, Shane, we didn't have any 22 data. So remember when I changed the date here to May of 2022 when we first built this model? We were actually, I can go back even here, but we were looking at it as if we only had the 2021 data, right? And we filled this in, and then we used the growth rate to project 2022 data. So look, our model actually projected revenue of 80 million or 80 billion in revenue. Holy crap, that's unbelievable. And their actual revenue, whether you look on the 10K or ROIC.ai, was 81,462. So our model is pretty close. That's like about a 2% error, which is pretty good, right? But we have to reference these new documents because the Black Mountain model hasn't been updated since 2022 when we first built it. And that's what you guys will do with any company you want to analyze. You have the template now, so you can say, look up Apple on here or, NVIDIA or Rivian or any company you want to look at and get their numbers and put them in for, their revenues and their COGS and everything that we're about to go through. And the model's pretty much entirely automated other than these inputs to the point where you really get to have really accurate analysis of the future of the business if you're getting the right information into the model. Does that make sense, Shane?
Yeah, thanks for clarifying.
Absolutely. Thank you for the question. And I mean, I hadn't even looked at that, but that is pretty cool. We are barely off. literally like $1 billion on a $80 billion number. So that's like a 1.5% error. So that's pretty sweet. And now we are, let's just put this as P, but for reference, guys, when you're copying formulas, it's literally just Command C and Command V. So even though I just manually overrode that, so P looks like projected because we don't have the data for 2023. Once we get that 2023 data, what you would do is make this number 2019 and shift all of these over one more, and it will give you another place here to put the 2023 actual data, and then the rest will be projected. So definitely going deep here, but trying to give you guys as many tools and insights as possible in a short amount of time. So assumed long-term growth rate. This is very similar to the risk-free rate, which is like the government bond on the timeline that you're looking at. So if it's 2024 right now, and this is 2027 that we're looking at, we actually need, instead of a 5-year risk-free rate like I looked at, we actually need a 3-year risk rate. So let's look at this, close that. 5-year bond rate. Let's see what the 3-year bond rate's at. Okay, right around the 5-year, so not too big of a difference. The long-term average is 3.39. Cool. The 10-year is what we're looking at for that first number, because that's like arguably the longest term. There are 20-year and 30 years that we can look at too. Wow, 20 years higher. That's pretty interesting. Makes sense. 30-year, this is like a very public metric. One of Kyle and I's friends, I believe, made like a 500x play using TLT shorts during COVID. Is that right, Kyle? But yeah, this is,
Yeah, that's correct.
it's crazy. So interesting. But yeah, as you guys can see, 30-year bonds are right around 4% too. So it's interesting as we are looking at here, just to make some observations. The 20-year is higher than the 30-year. So that means that there's some anticipation of inflation normalizing, but it's on like a longer timeline than, most people understand. But yeah, going really deep on this, honestly, like these numbers do matter, so it's worth doing the research. But for right now, we're just gonna call this like, say, 3%. And you'll notice once again how much it changes everything. And I think this long-term growth rate is also being if you push control and then the right bracket, it will show you everywhere that cell is being used. So yeah, this is being used not only on the cash flow analysis, but also in the terminal multiple, which is interesting. Makes sense. So yeah, so that's where it's really being used, is right here. So when we increase the long-term growth rate, it will increase the price per share, because that's being used in the terminal multiple of the business. So it's kind of better to be conservative with this. Like, even though it'd be technically more accurate to do 3%, we're going to keep it conservative because Tesla's already a high growth business, and we're in an uncertain macro environment, as we started the whole conversation off with, which means that it's better to be more conservative. We could even maybe bump it down to 2%. This model also has nonprofit crypto and other entity functionality, which is really cool. Really advanced. I haven't seen a model with that. Use at your own risk. It's actually doesn't change a lot other than like price per coin versus price of share. So just some small stuff, but a cool little feature of the model that you guys should know about. Getting back into the analysis, we'll now look at the cost of goods sold, which is basically the cost on all the parts. Once again, because we had 2019 here originally, we're going to just copy these numbers over and then put a new number in for 2022. If anyone has the ROIC.ai pulled up and wants to give me these numbers as I go, that would be super helpful. Cost COGS. Yep. So this is COGS. Let's just check it with our last number, the 4217. Beautiful. Now we have the new number, which I just copied in. And similar to this, we could go back before I move those over and see what our guesstimate was based on our historical growth rate. And that was 56, and it was actually 60. So decently close. Not the greatest. Research and development. Does anyone have that number for me for 2022? It's okay. All right. There's that gross profit number that I was joking about, biggest catfish in finance. Research and development right here. Okay, so we got R&D at 2593 for 2021 and 3075. So just out of curiosity. Yeah, really close on that one. We're looking at less than a 1% error on our previous analysis of that one, so that's good. Low key, guys, I'm just gonna put this on another window on my monitor so that I'm able to do this a little faster because this part is a little more boring and self-explanatory. So we got 3075. SG&A, selling goods and administrative. So this is stuff like salaries that you're paying your employees. Our model estimated 5.9. The actual number was 3.946. So good job, Elon.
So Elijah, if I were to use this model, would I have to use ROIC.ai to actually be able to use the financial model?
Oh, absolutely. Yeah, of course. There's other options too, like Yahoo Finance. That was one of the first things I pulled up. So, statistics or historical data is where you'll find financials, sorry, is where you'll find like that total revenue, cost of revenue, gross profit, all of that. But yeah, the whole point of a DCF, Shane, is that you're uploading information usually from the company's 10K into your template to get the analysis. ROIC.ai is just a little cheat code to do, instead of looking through these tedious 10Ks, you can quickly get all the numbers that you need pretty much. Yeah.
But in a way, would you say that ROIC.ai is a financial model itself, right?
It's not. It's just a data reporting system. Let me see if I have something up that explains that. Yeah, so look, this is a crypto vision track platform done by Galaxy, really cool. And basically like what this does, I do have a login. Let's see if I can get in. Cool. So yeah, what this does is it basically pulls in I think 1,700 crypto fund data. And you can see like, yeah, all firms, platforms, hedge funds, performance data, blah, blah, blah. And what this does, similar to ROIC.ai, is just shows you a bunch of data. There's no math done. For it to be a model, you need to do math in it. So that would be kind of like comparing eFolio versus this thing I was just showing you, Galaxy Vision Track, where like this just shows you data, which is kind of cool. If you guys look at this, actually, our fund just got featured on here. Shout out Kyle, really great work. Check it out, Black Mountain Investment Group, the Jupiter Fund, one of the top performing funds, like top 16 performing funds. Pretty cool. There's still some incorrect data on there though, so we're gonna need to update that. But anyway, this is basically ROIC.ai, where it just shows you data. And then like eFolio, which is our software version of a DCF model for a fund model, which is about 100 times more complicated than a DCF. That's basically the difference, is that I don't think there's actually any like software DCFs right now, at least that's public. But that would be a really cool thing for someone to build. And if they want to incubate it within Black Mountain, we will almost certainly make you very rich. And you need a lot of technical skills though. But yeah, so ROIC is just like an easy way to get data, and then putting it in the model is where your actual analysis is done. Yeah. So if you go through and complete all the rest of this, there's, depreciation and amortization. There is the provision for income tax, and these are all numbers that you just get directly off of the financial statements. The assumed growth rate is something that you can mess around with. 5% is pretty average. You could go a little more aggressive or a little more conservative. For a company like Tesla, you might want to go a little bit more conservative. Corporate tax rate is something that's actually mandated by the federal government. So as we saw in the Obama to Trump transition, there was that Inflation Reduction Act that we looked at, or I want to say some act that Trump did. I want to say it was Tax Cuts and Jobs Act that reduced the corporate tax rate from 35% to 21%, and that's where you see the change in our model too. But once again, this was an old number, so we're gonna need to move all of these over one and then get a new number for when Biden was in office, and I believe that rate has increased. CapEx, current assets, same thing. These are the current assets and current liabilities and net working capital are all balance sheet items. But yeah, I mean, once again, this is all super automated. Like in a lot of other models, you have to input all this. And for ours, you really just have to put current assets, current liabilities, and it will calculate all the net working capital, change in net working capital for you. CapEx is your capital expenditures, basically how much you're reinvesting into the business. And then based on all that, you get an unlevered cash flow, which is essentially like your cash flow without debt payments. And then down here is where we go into the equity value, the long-term debt and liabilities. These are also balance sheet items. Yahoo Finance is a really good way to find that data too. If you look at the statistics, kind of like I was saying, you see their market cap, their enterprise value, all that stuff that we'd really need. The equity value is not the enterprise value though. They're slightly different, I want to say. I'm also being cognizant of time because I know we'll get this wrap soon. Anyone who wants to can stay on and kind of watch the rest of this, but we are going to end it a little early, or not early, a little late. So sorry to keep everyone. But yeah, basically the idea is that once you get all these numbers together, equity value, long-term debt, the beta for the industry, which once again you just Google or you can find on Yahoo Finance, and put all the rest of this stuff in, then it uses the real data that you put into your model from the company's financial statements to perform a series of calculations about the future solvency of the business that therefore gets discounted back according to, that discount factor, which is essentially like the inverse of a growth rate. We're using that 10%, which is pretty accurate to what I was saying earlier. And then you reduce your cash flows based on that rate, sum them all up, and then use a terminal multiple, which is essentially like, how long you think the business is going to run. It's kind of analogous to a PE ratio, where Tesla notoriously has like one of the most disgusting PE ratios. I want to say it's like, 67.39, which is basically saying that the market thinks that Tesla has at least 67 years of runway at their current profit. That's how much their stock's valued at, which is crazy. And a terminal rate is very similar to that, but it's a little more mathematical approach to consider how much time left the business basically has. Cash, another balance sheet item. And then those are really all the numbers it looks like you need for this to be fully filled out. Once again, you can mess with the terminal value. If we made that 2030, of course, it's going to be more because it's a growing business. And then the ultimate outcome is finding, okay, if we know the share price today is $200 and we are confident it's going to be $400 in 3 years, is that a buy for us? To me, yeah, like that is a huge growth rate. Like that means that if you just divide, that rate by 3 years, that's a 70% annual growth rate on your investment. And so, obviously we didn't fill in like some of the expense numbers exactly right, which we can stay on and do if anyone's interested in. But you start to get the idea actually as you're going through these inputs about their revenues and their expenses, and you start to see like, okay, look, here's a great green flag in their business. Their revenue has a much faster growth rate than all of their expenses. That means that this is a well-run business, and it makes you bullish because their profit margin is actually increasing. Similarly, like if you look at their EBITDA growth rate, it's just huge, kind of because of these numbers up here that are showing how revenue is increasing faster than expenses, which means your margins are increasing. Other important stuff that I'll end on is that you can see these numbers are a little bit smaller, but they're still really important. Provision for income tax is one of the most important ones because people joke, like Wharton professors joke, that the IRS is your first lien creditor because like you have to pay the IRS always. It's like, a company's top priority. But Tesla for many years had negative cash flow, which means they got tax money back from the government. And so that shift just started happening really in 2019 where Tesla turned a profit and started paying taxes. And that, dramatically changes the outlook on the business. One, because they're profitable, but two, because, they are required to pay taxes. And that's kind of why we did this more conservative growth rate where we divided it by 2. I think it was 150% at first, and was making the model go a little crazy. And we were just unsure how realistic that was based on their profit projections. Because their EBIT we have growing at like multiple hundreds of percents. And so if we are growing the EBIT that much and the tax rate's growing like 150% on top of all the profits, it just kind of broke the model. So you need to think critically about how do we adjust our assumptions so that they're more sensical and realistic based on the current environment. But yeah, thank you guys all for listening. Sorry I talked so much, and if I confused anybody, I apologize. I'm here to answer questions for the next like 10-15 minutes, and maybe even finish out the rest of the numbers. Where as you can see, once you like understand it, the inputs are super easy. Like it takes maybe 5-10 minutes to input all those numbers from roic.ai. But the harder part is understanding it conceptually. So that's kind of why I focus more on that throughout the call.
Wonderful. Thank you, Mr. Elijah, for leading this class. We really appreciate it. And I think now is the time to open it up for questions.
Yeah, I just wanted to say thank you, Eli.
Absolutely. Is anyone interested in quickly finishing out the model? I think it will be like 4 or 5 numbers. It might take a sec to find the equity the equity value, but I will do it for sure if anyone wants to see it, just to kind of finish it off.
Sure, go ahead. I think it'd be pretty worth it.
Okay.
And if anybody has any questions, definitely feel free to jump in.
Oh yeah, absolutely.
And before we even, I guess, we officially, end it, I do want to say that we do still have internship positions open for Black Mountain Investment Group if you would like to get closer with the executive team in Black Mountain, and also get the opportunity to learn more about financial modeling and perhaps help us fundraise towards $5 million for the next couple of months. I think it's a great opportunity for you, and this is also an exclusive opportunity only for Business Brilliance members. And I think one more thing before anybody does leave, if they do, we will have a lot more exciting master classes sponsored by Black Mountain and other very, very big companies throughout the year. So just a quick teaser, the next one will be on AI automation and startups led by myself. And yes, that will be very interesting, and we'll have more information on that in our upcoming newsletters.
Amazing. Yeah, can't tell you how much I appreciate you putting all this stuff together, Shane. I've learned so much about AI from you through these master classes, and even stuff like the DCF, it might be a little less current, but doing these classes to increase your competitive edge will pay dividends literally and metaphorically throughout your entire career. So I'm so glad that you guys all came, and I really appreciate you setting this up, Shane, and all of you guys joining.
It was our pleasure to have you, Eli.
Absolutely. So yeah, I'll go ahead and just finish this off. It should be pretty quick, actually. So we covered all the revenue, all the expenses. Depreciation and amortization is a number that talks about how much the actual hard assets of your business are being like depreciated every year. This is a super similar concept to the discount rate, where it's like, okay, your useful life, and the government has amortization and depreciation lifetimes for different assets, like planes and boats and houses all have different lifetimes of depreciation. But a house, for example, I believe is 20 years. So you buy a house and you can depreciate it 1/20th every year, meaning it's losing value, meaning you pay less taxes on it, and have like kind of this write-off almost. So I'm looking at ROIC AI on one of my screens, and I have this on the other. I'll just pull it up. Why not? Maybe I can make it a little smaller. But so right now I'm looking for depreciation and amortization, if anyone sees it. Yep, right. Oh. Depreciation and amortization. Nice. So yeah, it's in their cash flow statement. 2021 was 2911. Looks like we have a slightly different number predicting 3345. Interesting. Interesting. So yeah, I'm not sure what happened with the depreciation and amortization one. This is a more difficult number to find a lot of the times, but 3747. 3345, pretty close. So yeah, as we can see, that actually had a pretty big increase in growth rate from 57% to 65. I think that was the biggest change yet. Provision for income tax, another super important one. Just moving fast through this. Income tax expense. 110, 292, 699. Yep. See, so that was just growing really fast. We saw like literally from 100 to 700 in 2 years is pretty insane. Which is why we kind of made that election to reduce the growth rate on the tax for the model. Same idea here, even with the newer data. We'll keep this out of divided by 2, but we highlighted it in yellow, so everyone who opens this model will be aware that that was an adjusted assumption. Let's Google corporate tax rate under Biden, out of curiosity. Oh, proposal. So I don't know if it's passed. Nice. Okay, so Biden's proposing 28%, pretty reasonable, honestly. I think 30 is fairish. But it hasn't gone through yet. So we're leaving this at 21, which is good. And then we have that long-term growth rate on the corporate tax just as like another conservative function of the model where we're growing the actual tax rate. Even though that probably is not going to happen, but if Biden's 28% does pass, we at least have some growth worked in, so we were more right than wrong on that. And we could increase that and be more conservative and have it hit like the 28% next year. That would be maybe too conservative, so that's why we kind of did that. 5%, maybe we'll make it 10. And if you guys look in our share price, that will have a slight impact, but nothing too crazy. 450 to 4 oops, hold on. Let's look down here. 450, 1, 2. Interesting. Oh, I think I know why actually. But yeah, so basically what we're looking at now is the difference between the corporate tax rate and the actual tax rate, what they pay. So what we see in this delta is the difference. So last year they actually paid less than they owed technically, and this is common because companies can defer taxes or push them into the future and save them up almost. So that's pretty common. It's questionable practice, but a lot of people do it. This is just an actual part of the model for your own analysis. It doesn't actually have to do with the output, but it's cool to see the difference in the actual corporate tax rate that they paid and the assumed payments or real payments. And yeah, you guys see this difference right here that I'm looking at. If we change that divided by 2 and take it out, then it gets closer to the actual corporate rate. But once again, I think it's a little too aggressive for the model. If anything, maybe we could divide this by like 1.5. So that would change the stock price for sure. Yeah, that brought it down from 451 to 448. So very marginal, but still important. CapEx, let's hope this one's easy to find. Capital expenditure is beautiful. Wow. So, oh, nice. Pretty good. So, seven one seven two. Current assets. Total current assets. So 2021 we had the nice projecting. Wow, 4917. That's pretty crazy. Current liabilities. Total non-current assets. So the difference between current and non-current is how pressing they are, like in terms of time commitment, and kind of about the depreciation and amortization thing that I was talking about. So total current liabilities, 1905, 26, 709. Nice. Oops. Six, 709. Crazy. Okay, we're almost done, guys. Interesting stuff so far. Yeah, price is being brought down because we saw a bigger increase in liabilities and assets. That's making sense. It's kind of good to always like check the output, the price, because it is important to follow the logic. Okay, now this part's a little harder. The equity value. Yeah. Okay, so Tesla. Literally can just Google it. Market cap is not equity value though, because it involves debt. This might be something you have to go in the 10K for. And equity value. Yeah. Let's Google. Let's look through Yahoo Finance. I think this is where I've found it in the past, is Yahoo Finance. That's a great return on equity from management. Okay, historical data, profile, financials. Wow. Okay, we're gonna ignore equity value for now. There is an easier way to find it. I'm gonna have to check on that though. And then total long-term debt and liabilities, that is an easier one to find. But interestingly enough, your total debt and your equity get added together to come up with the essentially like the value of your business, which is a little weird because it assumes that the creditors take ownership in the business, but that's just a finance thing. So net debt to equity or debt to equity, we had yeah, pretty close. So if we update this, the model's probably going to go crazy. I'm super curious what's going to happen if we change this. Oh, nice. 75. Okay, cool. Okay, we're also going to leave that actually, but I am just curious if I change this to this. Interesting. So yeah, it's weird because this is just how finance works. Like the more debt you have, the more valuable your business is. Because logically you'd have a bigger equity part of the business if you have more debt, if you're running a good business. But of course, even if you have more debt and it's more valuable, it would show in your financials if your cash flows are going down. So that's why this model is so powerful, because it really allows you to analyze like not only all the business operations, but the balance sheet and the cash flows and it in the broader context of the economy. So like if we looked at beta for Tesla, it's going to give us like a beta for the company, but it's a industry average. So you're going to use the full self-driving beta, which is really interesting. Wonder company beta. Or we could just do, yeah, Tesla's like such a big company that it's like kind of hard to qualify it in one category, right? Like electric vehicle industry beta. Can also look at fidelity for this, but yeah. Oh, this is interesting. Yeah, NYU actually has really good beta analyses. So if you look, like there's advertising, aerospace, air transport, auto and truck, number of firms, beta. So yeah, you see like the beta for auto and truck, which I guess we could put Tesla into, or transportation. Oh, electronics. Yeah. Real estate. So yeah, what you'll see is like real estate development has a super low beta, right? Because it's not very risky as compared to retail, which has a much higher beta. So yeah, this is actually, I'll drop this in the chat too, because this is like something super interesting to look at in general. REITs about even beta. But so what it does is it takes like the overall market return as one, and then it uses one as that benchmark for anything more risky than the market is above one, and anything less risky is below one. So I think we're using 1.45 in our model, and if we look at auto and truck, it's like 1.52. So we can try that. Don't think it will have too big of an impact on the share price, but let's just see. And that is something that you can update like every year. And it looks like it brings the share price down a little, which makes sense again because it is more risky, right? So, okay, assumed cost of debt we have to increase now. This was outdated. It's probably honestly more like 10%, which dramatically brings down the model. Tesla will have some information on this in their 10K, which you could get like a more accurate number, but you can also just use like the average of the market right now, which is high. And then that gives you your equity to value ratio and your debt to value ratio, which are basically just computed using the numbers that we completed up here. The WACC is then computed. So we saw based on the extra cost of debt, the increased risk-free rate, the increased beta, and the increased assumed market rate, that the WACC, the weighted average cost of capital, increased. And that's what we're using as our discount rate in the DCF. So that means that all of our cash flows are now getting discounted at a higher rate, which is going to have a big impact on these big numbers, especially deep into the future. And so, yeah, even just those small changes brought our stock price down from like 450 to 350, which is, you know, a meaningful difference. Probably, what is that? Like 20% difference. Pretty good. 25, pretty big difference. Let's finally look at cash. This is the last number we'll input. Cash and cash equivalents. We had, what do we have here? Yeah, 17,576, which is right, spot on. Now it's 22. So let's see what happens with our implied share price when we add some more cash to the balance sheet. What do you guys think is going to happen? It goes up, but just, oh, does it? Yeah, it goes up, but just a little. So that cash number is actually not that important because it doesn't really have anything to do with the operations of the business, right? It's just on their balance sheet. Same with the equity and debt value. It's more just to do like a gut check on the sustainability of their assets. But the more important thing is the sustainability of their cash flows. Of course, they go hand in hand. But the whole idea of this model is using both to come to a solution that makes sense. And so as you guys can see, you know, the implied share price in 2027 is 350. Right now it's at 200. So most people would say that's a good buy. That's about a 56% annual return. If we push that out to 2030, which is really easy to do here, we're now looking at a about 220% annual return. Oh, I got to divide that by 6 instead of 3 now. So 100% annual return. And that once again is something that you, while looking through the model, would think critically like, oh my gosh, their EBITDA is growing at a huge rate. Their revenue is growing faster than their expenses. So it makes sense that the further into the future you look, the higher disproportionately the share price will be. Okay, so thank you guys all for coming to the masterclass. If you have any questions, concerns, need help with anything, feel free to reach out. DMs are always open on LinkedIn or through Shane. But yeah, thanks again for coming, everybody. I hope you guys got something out of it. I have no idea if you did or if any of this made any sense, but it was fun, and always love going through this and helping people. So definitely oh wow, I didn't even notice this, but if you guys look right here, that's so funny. The model has ROIC AI, the Edgar, and where you're supposed to add like the company's 10K right there. So it's pretty cool. But yeah, so once again, thank you, Shane. Thank you everyone who participated. Hope you guys get something out of it.
Yeah, and I'm just curious, real quick, to since we're on here still, Evan, what did you think of this masterclass?
I'm relatively new to all this DCF stuff, so I thought it was really helpful, and you guys worked through it really thoroughly. So I learned a lot personally, and I'm very thankful that you guys gave us this opportunity.
Of course. And Diego, what did you think?
Well, I thought it was really good, but I really want to learn more though, because it's a lot of complicated terminology and subjects, and someone like me, I have freshman level knowledge. I think the hardest course I've taken is probably BEP 1000 or Math 1400, right? So I'm still not upper level, but I'm definitely interested in learning more. And if you guys have any resources, I'd be happy to like utilize them. And I heard you guys have an internship, so if you guys have like more information on that, I mean, I'd love to like take the opportunity and apply.
Of course, definitely check out. You should have received a newsletter in your inbox. It's all within that newsletter. We have the application link, more information on Black Mountain. And our next newsletter that we're actually sending out tomorrow will include the link to the article that Elijah has wrote, and we will also include the link to the financial model. So you should have access to all that information in due time.
All right, thank you.
Of course, of course.
Absolutely. Yeah,
And Ethan,
maybe we
Ethan,
could
what
even-
did you think of this?
Hi, I think it's very good. I just come to WITG Investment and Trading Group. Last semester, they have an accelerate program, but it's pretty excellent for this for this tonight. Very functional, practical. Yeah, I think it's very nice comparing to their last semesters. Yeah.
Awesome. Great. I'm glad that you found some value in it. We really definitely appreciate that feedback. And then Aiden, what did you think? If Aiden's not around, Mr. Nathan, Mr. Polo.
What's up, Shane? No, I thought it was good. I thought it was a good like overview of what a DCF was and just like running through the model. Also thought the resources you guys provided were really cool. Like Roic makes it a lot easier to go through the 10K, much better like UI than Yahoo Finance for that stuff. Shane also had a quick comment for like comedic PE ratios. I was looking at like uranium stocks the other day, and if you look up UEC or like CCJ, it's pretty funny, but it's like, so like uranium, like mining companies basically have like no earnings, but price
800.
kind of been popping, so their stock price is going through the roof a little bit, like over the past like year.
That is
So yeah, it's just
insane.
blowing up their PE
Wow.
ratio.
Dude, the PE ratio at 800 is bonkers. That's crazy.
What?
Yeah,
Dude, I
just
think
thought you get a kick out of that.
that's
That
amazing.
is so crazy.
That's
Oh my
crazy.
goodness.
Dude, I remember seeing Teslas at 600 one time, and that was like literally market top. And so I don't know what's good with
800?
Kyle. What do you make of this, bro? This is crazy. 832 PE on a uranium stock.
Yeah, they got to be doing something funky.
That's so crazy. Wow. Insane.
Unbelievable. Unbelievable. Wow. Appreciate that, bro.
Yeah.
That's great stuff. We need to talk more about that.
Mm.
Wow.
I'll catch you guys later. Great masterclass, Eli. Thanks again.
Thanks. Of course, I appreciate it a lot.
Yeah.
Yeah.
Thanks, everybody. Hope everybody has a wonderful night. And yeah, I think this concludes this week's masterclass. We'll have more in the future. Take care, everybody. Have a great night.
Thank you.
Thank you.
Awesome. You as well, Shane. Thank you, Elijah. That was great. That was wonderful. Great
Thank
stuff.
you. Appreciate you. Glad you like it.
Elijah, I'm on the way.
Okay, yes. See you soon. No worries at all. Sorry
Sounds
that
good.
took so long.
All good, all good. Melissa, we'll talk soon.
Melissa, you're the best for joining. Thank you. Okay.